I'm Kevin McCaffrey with Private Markets Insider and Crosse Investments 374. This is the Private Markets Insider webinar. I'm coming to you from Manhattan, where we're still locked down. And this is the most dressed up I've been for the past couple of months. I don't know about you, but I have to say, I feel pretty fortunate given that I'm also aware of all of the pain and strife that surrounds us pretty much every day. I sincerely hope that you and your families are safe and managing the pandemic as well as possible. And I'm cautiously optimistic that we can find a way forward through the racial struggles in our country at the moment. I did want to acknowledge that, and also that I really appreciate all of you joining me in this webinar format. Frankly, I miss having you out in person for the dinners and conferences that gave us a chance to connect in the past and made some of these interactions a little less awkward. But this is the new world, and I can only hope that we find some new normal sooner than later. Meanwhile, more than ever, there's a need for a community that drives successful transition for key contributors, insiders in the private markets. And as I guess a product of the 70s myself, I've been around for a few downturns, and the best performing opportunities tend to be those at the early stage of recovery. Of course, timing and deciding where we are in said recovery and where to focus, these are tough topics. And over the years, I've been building a community of investors, fund managers, deal sources, and the goal has always been the same: build valuable relationships through valued investments. I try to do this through what I consider to be my 3 C's of the event space. It's putting on valuable content like this webinar that we have today that brings us the contacts to the table to do deals. And that creates a community of people that trust each other. And that community, I firmly believe, is the most valuable tool that we have to navigate tough times. I've heard it in the past, in other crises. I've heard it from all kinds of different speakers and luminaries, including industry leaders like Larry Fink of BlackRock, directly telling me, as well as some of the family offices and independent sponsors that are increasingly a big part of the private markets community, and they're changing the private markets. All of them have told me that a community of insiders is crucial to success. So we're opening up input to all of you and honestly trying to understand what people need as we move forward, and aiming to save you time, save you money in locating appropriate investors, managers, deal targets, deal sources, and other key partners. So today's webinar is just a little sliver. It's intended as a preview of some of the broad range of topics and tools that we'll be expanding and dissecting in coming months. But today we have a pretty tight schedule. I'd just like to share quickly the information on our speakers. Webinar chairs today will be leading our discussion, and I'd like to thank Jim Snyder of HKW. I'd like to thank Jonathan LaCrosse of Crosse Investments 374, Michael Burke of Promethean Investments, Greg Imbruce, Roar Capital Senior, and Brett Hickey, Star Mountain Capital. All of their input and some of their insights will be on display today, and they've been very helpful in putting things together, in addition to some of the other featured speakers that you see below, key investment perspectives that we'll gain from Aberdeen and Schroeder Advec, Kingdon, Franger, so on. We also will be moving on into some deal presentations that I promised all of you at the very end. We will be sharing details on some of those on request, but we do need to hold off on some of those details for regulatory reasons and didn't want to share too many details ahead of time. So we'll begin with our first discussion, private equity investors, addressing issues of the day, as well as the second panel, private credit investors, addressing some similar topics. And then we'll move into those deal introductions that I mentioned, a special situation for natural gas company, as well as an equity financing for emergency oxygen technology. So I sincerely hope that everyone finds that useful. And I am now going to pass on the torch to our first moderator, and Jonathan LaCrosse will now be spotlighted here. And Jonathan, I encourage you to introduce yourself as I make sure that you're set with the appropriate speakers. Thank you very much. And please, Jonathan, take it away.
Great, thank you, Kevin. And it's fantastic to have Kevin on the team here at Crosse Investments. Known Kevin for the last decade and has been to a number of his events. So thanks for all you're doing, Kevin. Thanks for putting this on. So just briefly on Crosse Investments 374, we're a boutique fund placement advisory firm. We are dedicated to raising institutional capital for select private equity funds, for independent sponsor transactions, and for direct deals. So we'll specialize in working with a variety of sector-focused funds that are seeking to raise anywhere between $50 and $500 million. We work with independent sponsors in direct deals for equity and debt. We were founded in 2011 and have raised in excess of $4.5 billion and have also invested over $4 billion as limited partners. So if we get into our panel here, I'm excited to be joined by two LPs and two GPs. So we'll get a variety of perspectives here. So we're going to start off with Whit Matthews from Aberdeen Standard Investments. If you could introduce yourself and your firm, and then maybe you could talk about what investment opportunities you're excited about in this market. And then from Whit, we'll go to Jeremy.
For sure. Thanks, Jonathan. So yeah, Whit Matthews, I'm a senior investment director with Aberdeen Standard Investments. Aberdeen is a large global asset management firm headquartered out of the UK, investing really in every asset class that you can imagine. Our US private equity team is based in Boston, albeit we're scattered a little bit these days as we all kind of navigate the work from home environment. And our focus is on lower middle market private equity investing. We invest in really three core ways. We do primary fund investments. We do co-investments, both with traditional GPs and independent sponsors. And we're also active in the secondary market. As we think about the current environment, I think one of the phenomenons that we're really interested to see is how the emerging manager landscape evolves in light of everything that's going on in the market. The independent sponsor world has been growing by leaps and bounds over the last handful of years, and we expect the velocity of that emerging nature of programs and funds to really increase. So we've got our finger on the pulse of that world, and we're just interested to see how that plays out over the next handful of quarters. So I'll pause there and let you get to the rest of the panel.
Great, thanks so much, Whit. Next up will be Jeremy Knox from Schroeder Advec. And if you can introduce yourself, your firm, and some investment opportunities you're excited about.
Yeah, great. Thanks, Jonathan. I'm Jeremy Knox, a senior investment director with Schroeder Advec. Schroeder Advec is the private equity investment arm of Schroders, which is a global asset management firm based over in the UK. On our private equity side, I work out of our New York office focused on the US buyout market. We focus similarly on the small and mid-market end. We invest actively as a fund investor, but also very actively as a direct co-investor and in the secondary markets. We spend a fair amount of our time working with both emerging and established groups in terms of what we're looking for in current investment activities. I think there's in many respects been a bit of a flight to quality in terms of the GPs and deals that we're looking at, and thinking about who we're looking to partner with. It has been in the past few months typically groups that we know very well on the in terms of re-ups on the fund investment side. And then in terms of co-investment, it has been certainly concentrated in groups that we know well and typically have an investment with. So that flight to quality is certainly something that's resonated with us.
Great, thank you, Jeremy. Why don't we turn now to Michael Burke from Promethean Investments, and we'll give the perspective from the GP side.
Hi, we are we're just about to start raising our fourth fund. We are a special sits and disruptive growth investor, traditionally operating in the lower mid-market. I think this entire situation has been fascinating from a business perspective because it's very different to the 2009 financial crisis, where I think, there was a lot of adversity and conflict in terms of restructuring. Our first fund was 2005 to 2013, 40% IRR, but most of the restructuring and special sits we did post 2009 were relatively adversarial. What we're seeing emerging in the current crisis is a much more collaborative approach, which makes our job far easier. So we're inundated with deal flow in terms of traditional restructurings, and what's very interesting here is people appear to be prepared to pay for liquidity in this market, and there isn't the same sort of conflict going on. Shareholders are grateful for capital coming in to save the company, and the banks are in a more difficult situation, I think, this time round, and it's not their fault. So they're a little bit easier in terms of allowing people to come in alongside them. And, I think we're very excited to see what the next 12 months hold in terms of opportunity. We've done a couple of small deals since the crisis started, and we've got a couple of multi sort of deals in the $100 million plus bracket in terms of restructuring. And, I think it is going to be a very interesting market. I think this is different to anything we've seen before. That's really us. We've been in the US just under 5 years now, and we're established in the UK for 15 years.
Great, thank you, Michael. Jim, if you could take it away.
Yeah, good morning. I'm Jim Snyder. I'm a partner with Hammond Kennedy Whitney. HKW's been around since 1903. I'm based in Indianapolis, where most of our partners are. We have an office in New York as well. We're currently investing out of our fifth fund. We are small middle market buyout focused. I think right now we're spending a lot of our time, and have been since March 14th, really looking at the operations of the company, understanding. I think it's important that people, and sort of, you're past the initial stage of figuring out where your supply base, what's your demand, how to protect your employees, looking at liquidity. I still think those four things are important. Specifically, we continue to focus on the supply base. And as people start back to work, I think it's vitally important from our operations side to really understand. We haven't had any businesses shut down, so we've been working on it. But as people start back, we spend a lot of time on how do you properly ensure your employees are going to be safe. What's going to happen after you restart if you have an incident of COVID-19? What do you do, and how do you do it? So I think people on the phone that have operations really need to start, if they haven't already, really pay attention. On the deal side, unlike Michael, on the buyout side, things are just shut down. We're starting to see signs of life. I talked to our sourcing folks yesterday. There are a few deals coming in. There seems to be a lot on the sidelines. People are waiting. I think the big issue is going to be, how do you figure out what the right projections are for the year? How do you adjust for any sort of sudden loss in business or changes in the businesses because of the crisis? I think it's going to be the key issue for us. And we're seeing a lot of opportunities for add-ons. So we've got 4 that we're working on now. We hope to close. I think it's a good opportunity for us at this point in time to really look for tuck-ins on our portfolio companies and get capital work that way. I think the new deals for us is going to be more towards the end of the year, frankly, as you got to let things sort out. And it's going to take some time to understand if businesses have been impacted, because of COVID-19 to understand how that's going to play out long term.
Great, thank you all. Appreciate doing that. Let's jump into a question here. The Wall Street Journal recently reported on May 18th that there were 59 distress funds seeking $67 billion. And I'm sure there are more funds that have not been reported. Historically, distress funds have outperformed in past recessions. We did extremely well when I was at the Robert Wood Johnson Foundation coming out of the bubble in 2000, 2001, and did really well when I was with CalPERS coming out of the last recession. So which sectors and strategies will outperform, assuming that we're in a recession? The public markets certainly aren't acting that way. And then which strategies, whether it be non-control or control. So I want to hear from two panelists, one on the GP side, one on the LP side. So Michael, I know you said you specifically focus on special sits. If you could jump in here on this question, and then we'll go to Whit's perspective from the LP side.
So I think what we're seeing at the moment is really liquidity positioning within businesses that require support, and there's a lot of opportunities coming out of the banking market at the moment in terms of debt and deleveraging or providing additional debt lines, whether that be pre a Chapter 11 reorganization or whether it be kind of in that deeper restructuring piece. We're looking at a business at the moment which hasn't been impacted by COVID in terms of bottom line or top line. It's in the business services space, but has been impacted by its inability to roll over its funding lines at the current time. And although the business is performing in line with last year, the banking group were expecting a disposal and a significant repayment, and as a result, they want to bring new capital in to achieve a slight reduction in the debt and also provide some more liquidity to the company. And the shareholder group are open to that. It's got a fairly sophisticated group of investors in that business, and it appears to be relatively consensual. And we're able to structure, effectively senior terms, albeit in a relatively complex instrument, to target kind of 20% IRR over a 3-year period, with an opportunity to potentially convert into equity should we decide to do so. And it's those kinds of transactions that we're focusing on. As I said earlier, this seems to be a much more collaborative crisis than 2009, and because a large majority of the businesses have had to access funding, I think they fall into two camps: those which have been shut and impacted by the COVID crisis, and those which continue operations and are unsure about the future. And it's probably the latter category that we're seeing is more attractive at the moment. And we're seeing, lower levels of distress in that category, but significantly higher pricing in terms of what we're able to structure for as a minimum downside protected return. So we're not sure, obviously, how long the opportunity is going to continue, but it does feel very different to anything I've worked through before, either in 2001 or 2009. And it's far more attractive for high upper teens returns, I think, at the moment than any of the other crises we've worked in.
Great, thank you, Michael. Whit, you want to take it away?
Yeah. From our side, and maybe kind of going back to the beginning of your question in terms of the stress funds that are out there in the market right now, we're firm believers that having GPs in our portfolio, that have expertise, around special situations and or distress, plays a role in any cycle, and especially in the lower middle market, right? There's always going to be small businesses out there that are going to be in some form of distress or have some form of heavy lifting, where a GP that can bring, unique resources to bear is going to be able to generate value for the portfolio. So we've always had exposure to kind of special sits and or distress GP oriented folks in our portfolio. In terms of leaning in and getting heavier to managers in this strategy, right? It's important to note that any funds that are getting raised right now aren't going to get deployed for a little while. So you really needed to plant those seeds, pre this COVID recession in order to have the managers kind of on hand and ready to take advantage of the opportunity set here. Because as Michael alluded to, nobody really knows how long this stress is gonna be. Outside to distressed in particular, as we think about funds and commitments to GPs, right? It's not rocket science, but we're always looking for managers that have some type of unique and differentiated skill set. Often that is in the form of sector expertise, but it may also be in the form of kind of unique resources that a GP can bring to bear in terms of operating expertise and professionals that they can bring to the table. So we're always looking for those threads right now. We like recession-resistant businesses, so things like tech and healthcare, have continued to play an important part of our overall portfolio construction. I think an interesting comment, or at least observation, as we kind of look at the portfolio and we look at the world today, tech and recurring revenue businesses, for the most part, have continued to do pretty darn well. And when I say tech, I'm thinking broadly kind of SaaS-oriented businesses. But healthcare, as kind of just a broader bucket, has been incredibly meaningfully impacted by everything that's going on. There's lots of healthcare services businesses out there that are essentially four-wall operations that have been, just shut down, right? And we all know what's going on in the world, but certainly something we kind of never prepared ourselves for. And I think, as Jim alluded to in his earlier comments, there's going to be all sorts of diligence kind of threads that folks are going to be thinking about differently that we never thought about in a pre-COVID, pre-pandemic world.
Thank you, guys. Appreciate that. Why don't we jump to the next question following what Whit was just talking about with diligence. So maybe we can get the LP and GP perspective from Jeremy and Jim of how you're conducting diligence in this limited travel environment. So Jeremy, you want to take it away from the LP perspective?
Sure. Yeah, so I think obviously our diligence has transitioned, or very quickly after offices were closed and travel was shut down to being completely virtual, and that's taken a couple of forms, with both introductory meetings that have transitioned to Zoom calls, which I think have all gotten pretty accustomed to at this point, and then with I would say more in-depth traditional due diligence for fund commitments that we're doing. Or even co-investments that we're looking at, obviously that being via Zoom as well. And I think what we've tried to do is try to replicate as much as we can the feel and look of an on-site DD that we might have had on a fund investment, for example, via a Zoom call. And that might be segmenting one-on-ones or even two-on-ones with more folks from our side with a particular partner at a GP. And trying to, again, replicate that feel and look that we have in those on-sites, and also to try to get a sense for the people, as that is certainly a softer side of underwriting in any of these fund commitments, but equally important, perhaps more important. And then for groups that we have progressed to commitments on, it's been doing as much as we can via desktop, and then I would say trying to have meaningful sessions that are frankly, probably shorter than an on-site session would be in total, such that you kind of avoid that Zoom fatigue that we've kind of talked about internally of sitting through AGMs or even due diligence sessions whereby after an hour, 2, 3, there certainly is that loss of attention span. So trying to be succinct and I would say perhaps more efficient with our due diligence processes in this environment is, I think, something that has been interesting to note, and maybe something that we carry forward through through normal course as things recover.
Great, thank you, Jeremy. Jim, do you want to comment?
Yeah, I think from a deal perspective that, again, add-ons are easier. It's people, generally we had been in touch with them before March 14th, so we're just closing the legal accounting side. You can go forward, just trading data, making sure everything checks out. I think on new deals, it's going to be harder. You can have initial meetings. You can talk to investment bankers, have initial meetings, but I believe at the end of the day, you're going to want to, you're partnering with folks that you're going to want to meet face to face. At least at this point, that's our position. So even if something started, we could have an initial call, but I don't think you're going to see a lot of closings on buyouts where there's not an immediate need for the seller to sell or an immediate need for the buyer to buy until people can travel. And frankly, right now, I think if you told somebody you were coming, they'd say don't. So it's just, I just believe the market's going to pause until that happens, at least on the buyout space. If there's an immediate need, Michael may not have to travel, but for us, it's important to partner with the management team. And it's really hard to establish that relationship and partnership if you don't meet with them in person. So at this point, that's going to be sort of where we're at in the process.
Great. Jim, let's just stay with you. So supporting your portfolio companies, how are you doing that, again, in a non-travel environment and overall going through the different challenges?
Yeah, we have 3 operating partners, which in the beginning, they were talking to the companies daily. We were having calls as a group, 8 o'clock each morning. We're now down to 2 times a week. They're still talking to the portfolio companies pretty much on a daily basis. So we're not traveling. We're doing board meetings virtually. I was just on one last week, but really trying to stay in touch, not only with the companies, but also with their lenders. So we're in, our transaction folks have transitioned, since we're not doing transactions, to working a lot on lender relations. So they've been weekly calls with the lenders. I will just echo a couple of calls. I think on the lending side, the regulated banks have been very patient this round versus what happened in the last downturn, where the regulators and the regulated entities have been very patient and are trying to work through situations with all the companies. So we're very happy about that. But our transaction teams have transitioned to do that in large part. So pretty much daily communication. Right now, we're focused on, again, our companies that had production facilities. They've all been up and running. So we've had to deal with how do you prepare for an outbreak of COVID, or at least cases in the plants. I think the next phase we're working with them is how do you reopen an office setting? People are starting to do that. So what's the right procedures? We just want to make sure everybody's consistent, respectful, and trying to be very careful with the health and wellness of our employees. So that's what we're really focused on, and continue to focus with our lenders reporting. We've talked to my perspective. We've been spending out, was twice a month. Now it's once a month updates on each company to our LPs. And also then we've had extensive calls sort of on twice a month now. We've been trying to have one-on-one calls with each of our advisory board members. So a lot more high touch. I think people just want to know what's going on. So I think communication with both lenders and LPs is critical right now. And obviously daily conversations with the operating folks with our companies, just to make sure we can support them, even though we can't get to them, we can support them in a lot of ways from afar. So that's what we've really been working on.
And Michael, anything in addition there of how you're supporting your portfolio companies? We only have a few minutes left, so if you could maybe give us 60 seconds. I want to get one more question in.
Yeah, I think from our side, it's a lot of communication and, a lot of dealing with the creditors and the stakeholders. So, we get very heavily involved in, the working capital usage of the businesses, as you'd expect. And, in a lot of instances, I'm doing a number of calls on a daily basis, dealing with key creditors or suppliers, chasing money, putting people on hold, talking to the banks, and, working through all of these things. And, I think that kind of focus on working capital and cash is also critical during these times. And it's surprising, the big difference between this recession and the last recession is that this was caused by an external factor. So everybody is extremely tolerant of situations. And we've had some great results with deals where we've been able to come into the senior at a very low price and basically, restructure the company in a collaborative fashion with the creditors and the debtors of the business in a really extremely fast fashion compared to how that would normally go. And everybody appears to be very supportive.
Great, thank you so much. And Whit, let's jump to you. What does an emerging manager, I think you talked about that earlier on the panel here, what do they need to do to stand out? And then we'd love to get Jeremy's perspective. I know that you had mentioned there was a flight to quality. So what does, my pipeline's the largest it's ever been, and a lot of those are emerging managers. So what do they need to stand out, and what are to get dollars from groups like yourself or others?
Yeah, for sure. So maybe putting the current environment aside here for a second, as we think about the independent sponsors that move to the funded model, right? The folks that have been, most successful have been groups that have kind of operated for some period of time, often unfunded and independent, and been able to kind of prove out their sourcing engine, right? Because one of the toughest things to do, if you're as fortunate as Jim and the team at HKW is, right, they've built a great brand, they've got the BD funnel kind of working really well. There's no promises that if you leave your current shop and you hang your new shingle that you're gonna be able to keep that deal flow going. So I think that's one of the data points that we look at, and as we look back on the independent sponsors that have evolved, really strong sourcing and ability to do that, regardless of the environment, is incredibly important. So, to put it bluntly, it's getting a handful of deals done that make sense and fit together and align with the thesis that you've laid out for the groups. I'm sure there's the story of a full team kind of coming out of shop and having a track record. But that's a really small percent of the overall universe of emerging managers. I think as it pertains to the current market, right, the folks that are going to be most successful, and this goes back to what Jeremy was saying earlier on, they're going to be the groups that had kind of planted the seeds in terms of relationships, with LPs like ourselves earlier on, because it is going to just be that much tougher for the marginal, independent sponsor, emerging manager to build those new relationships.
Jeremy, final comments?
Yeah, sure. Definitely echo a lot of or all of what Whit said. I think it's also important, and what we found in some of the conversations we've had of that transition from independent to funded sponsor, of really defining and having a very easily communicated strategy of what you are as a GP and what you stand for. One of the things that we kind of always ask ourselves in underwriting is how would you define a perfect XYZ GP deal, right? What does that look like? And that's something that we think about and really try and narrow in on when we're thinking about emerging managers and groups that may have come together from disparate places, may have different backgrounds from an industry perspective or transaction type perspective. So really honing in on really what you stand for as a GP, such that we as an LP can get conviction behind that and really find that point of differentiation or competitive advantage. So I think that's something that is important, along with trying to establish a track record and likely building a team. And that's one of the things we also pay a lot of attention to. Are you trying to build a real platform for and building franchise value as that GP, or are you just trying to do a few deals, get a couple of different carry streams under your belt, and that's not typically the group that we're going to be backing. We want to see that they're building for the long term to build a true kind of institutional quality private equity firm.
Great, thank you all. Appreciate all your time. I wish we had more. I got lots of more questions, but Kevin, back to you.
Yes, thank you very much, Jonathan, and all of you for your comments. And I'll echo that sentiment that we certainly need more time to dig into the expertise of each of you. And I'll just remind you, this is simply a sliver of the type of content we would like to bring together to gather these kinds of insights. So in the future, we'll delve in a little deeper and perhaps even build some working groups around specific topics. But without further ado, I'd like to, well, first of all, remind you that I'm with Private Markets Insider. This is an extension of a number of efforts that I've had over the years to bring together key investors and fund managers and deal sources, deal targets, and in particular, we'll be focusing a little more on deal targets moving forward. And in that role, I'm also working with Crosse Investments 374. And with that said, I would like to have our new panelists for this second discussion, private credit investors, discussing different emerging opportunities in secured debt or revised structures, or just the different opportunities that are being pitted against risks that everyone feels in these turbulent times. And to that end, I'd like to start with an introduction. Grace Livray, if you wouldn't mind introducing yourself, and I'll ask you also to please just include a little bit about your firm. I know that you've been with the firm for over 50 years, which is a really unique type of perspective. I think it's really important, that you have that experience. And so introduce yourself along with the firm and any insight into the types of opportunities that are attracting your attention at the moment.
Hi, so I'm Grace Livray. I'm the CIO, managing member of a family office. We don't take any outside money, it's all family money, and we're quite diversified. Yes, I have been there over 50 years. I started there when I was in high school and just never left for whatever reason. It's been a ride, and in 2008, when things looked horribly, I invested in distressed markets, and I was doing little SPVs, going through the FDIC and buying up loan pools, and it became extremely valuable and rewarding. And so I'm talking to those same people right now. I mean, we are diversified, as you can see. We have an equity portfolio, we have a debt portfolio, we also have a private equity portfolio. So I don't know how well versed I am in the credit markets, but what I can tell you, what's important to me is that I listen to the right people who know those markets. And what I'm being told right now is that nothing will play out now. They won't really have a sense of those markets at least for another 3 to 4 months. So, and I'm sure real estate, the distressed debt in real estate will be right up there on the top of the list. So, we're looking at some of that. We're looking at private lending, where these companies that really have just been affected strictly by this coronavirus, but we know will come through. We're looking at that sort of thing. And you're going to discover at this point there's going to be a lot of funds that will now get involved more and more into those markets. So I probably will look at that also.
Okay, yes, thank you. And moving on, actually, if Rosemary, would you mind introducing yourself and your firm and any attractive opportunities you're seeing in general basis?
Well, happy to. Well, I'm Rosemary Sagar, and I've been with Kingdon for the last 15 years, managing Mark Kingdon's charitable assets. Kingdon Capital is one of the oldest hedge funds. It was set up in '83. And the Kingdon Foundation was set up in the late 90s. And I've been managing the assets of that and some charitable trusts now since the beginning of '05. Before that, I was managing, I was investing in the public markets, international equities for 20 years. So I've seen my share of crises and meltdowns globally. So I invest 100% in alternatives. The bulk of that is in hedge funds, and then also I seek out niche strategies in private equity structures. The fortunate thing in this market is that for the last 2 years, I have been concerned that the bull market was getting tired, and I've been seeking out strategies that are less correlated with the markets, less correlated with the economy. So that's worked in our favor. We had made some allocations that had not called capital yet, but are now in full swing, taking advantage of opportunities. What I'm looking at is, I think we're seeing a return of hedge funds, particularly those with a low net exposure and that have expertise on the short side. It's all a question of what are your assumptions. My assumptions are that there is a disconnect right now between the real economy and the stock market. And a lot of this additional liquidity that's being pumped is showing up in public equities right now. And you look at the economy, well, I mean, GDP is going to be down something like 50% this quarter. And what concerns me in particular is labor, that labor might not be coming back anytime soon, because a lot of the jobs that went away are not going to come back. So maybe I should stop here for now.
Sure. Thank you very much. And moving on, I'd like to also add a correction here. As I bring on Greg Imbruce, I introduced him with Roar Capital Senior. It's simply Roar Capital, and I think it may have had in materials. Greg, you do a lot in senior secured debt, right? Perhaps that was somehow mixed into my materials, but I'll let you please describe your firm, your role, and opportunities you're seeing.
Sure. Thanks, Kevin. Thanks for putting this on. I think it's very helpful for everyone. We're a special sit fund focused on credit. My expertise is really in a bankruptcy specialist and expertise in energy. Been involved in the high yield market for 20 years, specifically in energy and power. We also focus on tech and med tech and med devices. So the fund is Roar Capital. We generally do transactions within SPVs so that we can move quickly. This is a great forum for us to introduce transactions. We have a transaction. One of the companies presenting today is a deal that we're doing by the name of Buzzard's Bench. It's a natural gas deal that's in bankruptcy. We see a lot of opportunities, obviously, today on the bankruptcy special sit side. We think that specifically in energy, you're going to see a tremendous amount of bankruptcies this summer. I think Rosemary mentioned disconnect. It's interesting. I was at Jefferies for a number of years on the high yield desk, and the high yield desk never really spoke to the equity desk, which was amazing to me. So you would have a stock flying, but the bonds are declining. And so there's, I think, a little bit of that going on today as we look across a number of industries. And it's really an opportune time in energy, I believe, because you have obviously a slowdown in drilling activity. So production, we're very bullish on natural gas. Goldman's calling for about 350 an MCF next year from current price. That's going to be driven by just a slowdown in drilling activity and the quick decline curves that you've had with fracking, where a well could decline from 100% day one to 30% at the end of the year. So we're seeing tremendous opportunities in energy space. We're also seeing, we do a lot across the life cycle of a company. So we also provide debt with equity to venture cap-backed companies that have revenue. So we're seeing, that capital dry up along with the capital and energy dry up, which is presenting some very interesting opportunities. And when we talk about distress, there are different levels of distress debt. You can go buy a bond, obviously, at 40 cents on the dollar. On an unsecured basis, go through bankruptcy. What we're really doing is we're getting involved in restructuring or the bankruptcy process. So it's, in our minds, it's the cleanest way to buy an asset.
Excellent. Yeah, thank you very much. And finally, certainly not least, but last on the panel, Brett, would you mind sharing a little bit about Star Mountain and opportunities you're seeing?
Thanks, Kevin, and hope everybody's having a great day. Star Mountain is a specialized asset manager. We focus exclusively on the United States, within the United States, private businesses only, and companies that generally have between 3 million and 20 million of EBITDA. We do that because systematically that end of the market is very large, fragmented, represents about 50% of GDP. Within that market, we manage about $1.2 billion of assets. We have over 30 full-time people. We're a 100% employee-owned firm where I founded the firm and give equity to 100% of our employees. So we're highly focused, as you heard on the panel earlier, around shareholder alignment and building for the long term, including having 2 offices in India that we've had open for over 11 years now that allows us to process proprietary data and information on a 24/7 basis that we think provides additional edges to our 2 core strategies. Those 2 core strategies, one is direct lending to privately owned businesses that people call non-sponsored, meaning companies that are owner-operated, that are not owned by large private equity firms. That allows us to be a strategic partner with them. And if you looked at our Venn diagram, the other aspects that contribute to that include financing some type of strategic initiative, most often an acquisition. A recent example, which is quite opportunistic in today's downturn, is we helped a high quality company with a good balance sheet acquire a competitor out of bankruptcy a few weeks back at what we believe is pennies on the dollar. And those businesses are then willing to pay for our labor and our services, which is part of how we generate the alpha at Star Mountain. The second strategy that we have is called secondary fund investing, where we will purchase limited partnership interests in other US lower middle market funds where we have an edge and a competency, including we have over 20 people in over 20 cities across the country, spread across the US. And so we can help better originate, underwrite, and manage private assets and take advantage of situations where people are looking for early liquidity in, again, a marketplace that represents half the United States and systematically grows faster than large market companies do, and actually in a less volatile manner. So that strategy in a market downturn, of course, is more opportunistic because more people are looking for early liquidity. And then the last thing I would mention that is interesting in today's economic environment is cheap debt, right? Everybody knows there's a lot of cheap debt out there. One of the programs that happens to fit our strategy well is the SBIC program, which one of my partners, a couple of my partners were highly involved. One was a general counsel, another one on the investment committee as well. But the SBIC program allows smaller managers to borrow money from the US government, 10-year fixed rate money, interest only based on the US 10-year treasury rate. So pretty attractive terms that certainly compared to any commercial terms. So I think that's also something that's interesting in today's environment, is being able to access low-cost capital and then be able to deploy it in what is historically a very opportunistic time.
Yeah, thank you. And sticking with you, Brett, I wanted to just check. Ardian, I know, just came out with a $19 billion secondaries fund. And Jonathan mentioned in the last panel, which was, I think, relevant, that, you know, the journal reported 59 distressed funds at 67 billion. So there are all of these efforts that are somewhat similar to what you do, but I gather that your main point of competition is that you're in the lower mid-market and can bring these larger market tools into that environment. Correct me if I'm wrong, and maybe just help me understand how it is you compete with some of these ongoing trends and just what's popular out there. What are the main things that are making people comfortable in this environment?
Yeah, good question. Actually, it pinged my buddy Mark, who co-heads the Americas for Artie, and we went to McGill University together and said, "How you doing?" He said, "Still in the city," which he's escaped out to the Hamptons. I haven't seen him in a while, as you can imagine. But yes, they just had an incredibly successful raise. People that are familiar with secondary strategies have generally seen that it is the highest Sharpe ratio investment strategy. So Sharpe ratio is one measure of optimizing risk-adjusted returns. Our secondary strategy doesn't compete at all with any of the large players because it's focused on smaller managers that they don't know. It's focused on assets that get very complex, like when you start to look into warrants and put options and all the complex structuring that goes on into some of these private small loans. It's not like the larger markets where, you know, a first lien loan looks like this, a second lien loan like that. You really have to peel back the onion and go through loan and security agreements to really understand structures and assets. And in the roughly 22, I guess, secondary fund positions that we have made and purchased, there has never been an intermediary ever in any of them. I don't like to use the word proprietary, but they're direct relationships that we have, and none of them have ever had a third-party valuation firm. So you have to really have the direct core competency to analyze and you have to find them, be able to analyze them and manage those assets. I think that's one of the key differentiators. And for guys like Artie that just raised 18 or 19 billion dollars in that secondary fund, yes, they benefit from some good market dynamics, certainly like we do, but you can't put that kind of money to work in small increments.
Okay, great. And taking that same question from the GP perspective to Greg, Greg, how are you competing and how do you see all of this distressed activity in the larger market? You know, how does that compare with the, you know, individual deals and, you know, the different focus that you have?
Yeah, thanks, Kevin. In energy land, there is not a lot of competition. There's not a lot of capital available. The banks have backed out probably about 6 months to a year ago. And the private debt is almost non-existent. So we're focused on transactions $5 to $30 million, and we don't see a lot of competition. Also, these transactions are fairly complex, especially if the restructurings or bankruptcies. It takes a lot of time and effort, and again, deals just too small for the bigger funds. So we're able to drive very fair, reasonable terms, and also obtain some of the equity upside. As we really are, in a sense, equity partners, we're putting in a lot of time with system management, and that's something, you know, a little different. We also will buy high yield bonds, but you know, we don't really see the opportunities in high yield that we see on the private debt side. And companies recognize the current environment, whether it's an energy company or a smaller company seeking capital that may have raised 5 to 10 million on the venture cap side, that has a great product and now needs marketing dollars in this type of environment. So we're able to pick the spots. Deal sourcing is, we have incoming calls frequently, just from the relationships I've built over the years across both the buy and sell sides.
Right. Excellent. Okay. Well, look, it all sounds wonderful coming from, you know, the GP side. And I'm very curious to hear, Grace, if you can give me your perspective from the LP side. What do you think of the types of debt opportunities that you see out there? I know you mentioned you're not, you know, heavily focused on that, but in particular, maybe you can answer a quick question on whether you are looking more at direct deals or fund management. I've heard a lot of discussion among different family offices in particular that are starting to do a lot more direct deals, whether or not, you know, they want that specificity and breaks on fees with direct deals, or if, you know, they need a little diversification and, you know, professional management of a larger team. Are you more focused on funds or deals in the debt environment?
So personally, I mean, I would be willing to do both. I mean, right now we're in a public, we're in BNY Mellon Alcentra, which deals with, and it's a fund which deals with debt. And so hopefully it's down a little bit, but we'll come back. I mean, we've been with Blackstone's distressed debt fund. But again, I have to go back to 2008 and 9 when I was sort of partners with this group that was doing loan pools. It was a total win-win. They know their stuff. They do it as an SPV, so each deal that they do is separate. It's not a fund. And I've been talking to them, and they're looking. And you know, I don't want to get involved in the big deals where they're raising $100 million to do it. I think if we stay under the radar and do the smaller deals, that's what was lucrative back then, and stay away from the big guns. I think there are better opportunities, at least for my family office. I can't speak about anybody else, but I am interested. I want to do it. I have to wait to see what the experts tell me.
Right. Yeah. So it's certainly situational. And I appreciate your point that you can only speak for your own family office. That's one thing I've heard a number of times is if you know one family office, you know one family office. It really doesn't carry over. Everyone's a little different. And with that, Rosemary, I'm interested to hear your perspective on, you know, in particular, whether you're looking more at direct deals or fund managers that can navigate all of this. And beyond that, just, you know, any comments on everything else that was said about debt markets?
Well, I think we're in an environment now where there's an exceptionally wide range of outcomes because we just don't know yet. I mean, the markets have been holding up remarkably well, but as I said, I think there are some structural looming problems in the labor market, and that means incomes. And that means, you know, GDP is likely to remain on the soft side. So in the market, in terms of investing, I believe that we're going to see a return to active and fundamental managers and away from passive. The percent of passive and systematic investors had reached an all-time high over the last, well, just steadily rising over the last years. And we got to the point where only something like 13% of trading volume is accounted for by fundamental investors. And I think, you know, this kind of volatility that we've been seeing is going to cause a change in that. And we have been seeing some signs already. So I also, you know, I think that there's also a return to looking at value. We've been seeing a shift from a bit of a shift anyway from COVID crisis beneficiaries to reopening beneficiaries. But so I mean, there's going to be so I think that's one trend. We have actually stayed away from individual deals because, quite frankly, we don't do enough of them. And I prefer allocating to a smart manager. And in my mind, the key in this market, given the very wide range of outcomes, is that the manager has a wide enough universe to have somewhere to hide as things change and as the assumptions need to be updated. So that's why, you know, I mentioned, I think, you know, within hedge funds, that means going to long short and with low net exposure, and but seeing opportunities both sides. And so we're going rather for broader universe versus narrower. And right now we're not looking at individual deals. In terms of private equity structures, there are various sort of special situations focused, and we've always liked secondaries, and we're looking to allocate to some funds that we already have been in and that are doing a repeat fund. So we're completely on board with Brett on that, and in terms of full disclosure, I'm a personal investor in Brett's fund, so thumbs up to what he's doing. Yeah, so
and that's fine. I don't.
Of financial dislocation and secondaries are something that I would highlight as themes.
Great. And you know, while I'm with you, you mentioned that active versus passive dynamic, and I think that's been playing out for a while. Financial engineering is often a big part of what makes private transactions valuable. But in these types of markets, whether it was just before, you know, pre-COVID, with you know, the difficulty in finding you know, something at a decent valuation, or now where there's such little transparency, it seems like that active role is even more important. And I wonder how that also translates into your role as an investor. Are you typically in a control or a non-control situation? Maybe just a quick note on that.
We are in close touch with our managers, but we are not in control, and we're a very small team, and so we like to allocate with good champions and leaders who are in close control of things, and so we delegate that to roll one layer down, if you will.
Right, fair enough. And Grace, moving to your perspective on a similar dynamic in terms of control, are you focused mostly on active managers, or in direct deal situations, are you looking at control? Yeah, just how do those dynamics play for you? How are you protecting collateral is really the issue here.
So, I mean, the funds that we're in, or the funds that we've been looking at, you know, of course, I don't have any control. It's a decision, and you can only go by their history. But as far as the people that I will be doing this distressed debt with, yes, I will have control. I had it back in 2008. Each deal is singular, so you get to pick and choose what deal you think is lucrative and what deal you want to be in. They've also allowed me to be hands-on and visit the different, companies that are in distress. So I will probably lean more towards doing that, and and just sort of hope for the best. I am not. I'm not stupid enough to believe that I'm smart enough to know these markets as well as the people that have been dealing with these kinds of markets over the last couple of years. So that's really the direction I will go in.
Okay, thank you. And I'm going to take a little bit of liberty here, and we should be transitioning over to the deal presentations at this moment. But I'm going to ask Greg and then Brett to just quickly, in 30 seconds, what's your elevator pitch on how you're protecting your assets? Or, yeah, please.
For me, Kevin?
Please, yes, Greg.
Okay, thank you. Yeah, so we have very detailed loan docs, security agreements, control agreements with the banks, probably about 20 or so different covenants and negative covenants, which basically gives us effective board control of those assets to make sure that we're in line with the plan and the financial projections and meeting the milestones and benchmarks that we set out. But at the same time, working with management, those covenants there, that type of control, negative control there, simply to make sure we stay on track. We've only had one real instance of having to go after the collateral, and it's on a very cooperative basis where we sold the assets and did very well on that.
Okay, friendly distressed investors. We see all
That's
types.
Right. That's us.
Brett, what's your secret?
It's, I guess, learning lessons over time is one, but we start with a very data-driven investment approach. Top of the funnel is the right type of industries that have thematic tailwinds, less cyclicality. So while I paid for college working on the oil drilling rigs, I'm not one to try to do what Greg does as a specialist in that space, which I think you really have to be. So we focus on industries that are growing with tailwinds, then good balance sheets, fundamentals, low leverage, high liquidity. And I think that's what's helped in the nearly 100 deals we've closed to have a 0% realized loss rate across our firm. And then very active management and only investing in U.S. private businesses that if we do have to take control and so forth of them, that we have the full competency and capability to do that, both legally and operationally.
Okay, yes, thank you very much. Now, Greg, while we go to pull in the presentation that you have for actually 2 presentations for deals, I would like to thank all of our panelists for joining us. I really appreciate it. And Brett, I'll let you return to the mountains in your background. And I appreciate all of your help and your insights. Rosemary, Grace, thank you very much. We clearly need to dig into a lot of specifics moving forward, and I hope to have you back, and I'll be happy to facilitate any discussions among some of our guests that would like to touch base with Greg or Andy and get further details. And we hope to bring you more of these types of interesting deals in different areas throughout the spectrum, and also to gather your input as attendees and as panelists into what other issues we should be addressing. We will be trying to sort out exactly that, which speakers and deals to highlight for our next webinar on July 1st. We will expect to continue these on the first Wednesday of each month. So then the next one would be August 5th. And we even have one of our famous insider summits with a more cultural angle and bringing people together live in Manhattan, scheduled for November 11th. Of course, that was delayed once from April, and I appreciate the patience for those of you that were involved. And we hope to continue in November and in a safe manner, bring people together, because as I said at the top, you know, this community of investors and fund managers, deal sources, deal targets, other key players is the most important tool that we have to navigate these turbulent times. So I'll be reaching out to gather input from the attendees and also to give you more details on upcoming events and the marketplace that we are putting into position to help people to transact and so on. We'll actually be taking input for an advisory committee, and don't be surprised if I reach out, and feel free to reach out to me with any input. I really appreciate your participation. And with that, I will be ending today's webinar. Thank you very much. I appreciate it. And for those of you like Michael Burt over across the pond, perhaps it's time for a cocktail. I hope to join you at some point soon. Thanks a lot.